Hi, it's Arjun. This week, we want to continue that theme of just call it normalization in energy markets and away from that intense 2020 to 2023 period where people were calling for an urgent energy transition, a move out of fossil fuels, somehow only into renewables within the next 5 minutes, all the peak oil and gas demand concerns that came with it, and a decent amount of ESG hysteria. All of that extreme mindset we think is fading, and it's being replaced what we're going to call more pragmatic discussions and essentially a normalization of the key issues. We're starting to get back to just regular supply, demand, price debates that we've always had in energy, that are always going to exist. And again, away from these concerns that there's either an existential threat to traditional energy or somehow the future is entirely in new energies. Some of the issues being faced today in oil markets is the uncertainty in China. And one of the things we want to do this week is go back to something we used to do during the 2000s super cycle, which is to look at copper markets and frankly, base metals and metals and mining more broadly. But copper specifically, we used to spend a lot of time with our analysts over in Asia and that covered the metals and mining sector to understand what is going on in copper markets. It was often a better or more timely reflection of what was going on in China and some of the developing world. And we're going to use some of that analysis to look at what's going on with crude today. There is quite a gap right now where copper is doing significantly better than crude. And I think the question is when or how will that gap close? And will it close in favor of copper or copper close in favor of crude oil? So I want to use some stock price performance analysis to highlight this movement from, again, extreme urgent energy transition type narratives to something more normal. I'm going to use the yellow line, which is the ICLN, iShares Global Clean Energy ETF. I'm not a fan of calling anything clean energy. There's nothing clean or dirty, but that is the official name of it, versus the white line, which is the XLE. I think everyone knows the traditional energy sector ETF. It's essentially the energy stocks in the S&P 500, all of which are the traditional energy companies. And the blue line, of course, is the S&P 500. There are kind of three key performance periods here. First is that immediate pre and then post-COVID, significant outperformance of new energies, the yellow line, versus traditional energy. This was building up to that peak narrative that we are in an urgent energy transition and that the future entirely lies with new energy and that traditional energy should be left for dead. And somewhat ironically, or otherwise, it was actually President Biden's inauguration that coincided with the peak in clean energy or new energy sentiment. And it's actually been from the start of 2021, really through most of 2023, the combination of rising interest rates, some cost increase from what previously had been a cost reduction trend, as well as a recognition that many of the newer technologies, things like hydrogen, even electric vehicles, were not going to ramp as smooth and easily as the perception or the consensus believed, especially at the peak of 2021. It was all of it. It's going to be harder. It's going to take longer. Interest rates aren't for free. The costs aren't going down as much as they were in the past. It's going to be a choppier path. And at the same time, we, of course, had a dramatic recovery in traditional energy. Here was essentially the opposite effects. It was a really tough decade in profitability last decade. Profits were improving. The sector was showing more discipline. Prices were rebounding. Demand was rebounding. And we, of course, then were boosted, especially in 2022, by Russia's invasion of Ukraine and the surge in both natural gas, LNG, and crude oil prices that occurred over that period. So huge outperformance for traditional energy over a 2-year period. And that's really given way to what's now been a more lackluster moving sideways period where you just don't hear the talk about it's all or none for either of these sectors. It's not going to be all about new energies, but for that matter, it's not a straight line up for traditional energy either. And it's been about 2 years of going sideways for traditional energy. And it's been about 1.5 years of going sideways for the new energy sector. The new energy sector faces some of those same questions of, okay, it's not going to be zero going forward, but what is going to be a realistic adoption curve for EVs? Is there really a path for hydrogen and some of the new technologies? Solar is going to grow, but what does that mean for some of the residential solar names, which are in these US indices? And of course, for traditional energy, questions about, okay, we've come off peak profits from that mid-2022 period We're in a little bit of a downdraft here in crude oil. What's the fate of China? Again, all sort of normal discussions, but the sort of death match, as I'm calling it, between new and traditional energy, I think is giving way to really much more normal discussions about both sectors. And of course, you fast forward to where we are today, and who turned out to be the winner? It was the merchant power sector, which no one was talking about over that 20, or at least no one in these circles was talking about over the 20 to 2023 period. This is actually a graph of Vistra. I don't mean to single out just one name, but they had the history going back to 2020. Didn't quite see that for Talon or Constellation, but dramatic outperformances. As I've shown in other videos, the merchant power names, Vistra, Constellation, and Talon, have actually done as well as NVIDIA, or since mid 2023 for about a little over a year and a half right now. Merchant power is an interesting area, and somewhat interestingly, I think it's the bridge between the two worldviews. If you are an urgent climate crisis, we must transition urgently, some aspect of that was going to come through electrification. If you've been in our camp, which says, well, you first have to solve for everyone in the world being energy rich. Well, a big part of being energy rich is power generation growth. And a big part of even the developed world is improving and adding to grid resilience, meeting AI and data center growth, and all these kind of things. Power, I think, is going to be that bridge. And I'm going to say that the big technology companies, they are going to be our salvation to a healthier energy narratives going forward. All those companies recognize that you need 24/7, 365 dependable power that is affordable, but they are going to also care about their emissions. But they're also going to be realistic about the pathways going forward. I'm very appreciative that those companies have recognized, hey, our emissions have risen here in the last couple of years instead of going down. I'm talking about the tech companies. But we have to build out these data centers. And we're going to take steps. We're going to partner with nuclear. We're going to try and figure out geothermal. We're going to do some solar. We're absolutely going to do some natural gas. We're going to do all of the above. Maybe not coal for those tech companies, but we are going to do all of the above. And again, I think there is a lot of comfort and solace to be taken in by the fact that this merchant power move and the power generation aspects of energy going forward, I think it's going to lead to healthier outcomes for all of the sector. And of course, again, it turns out power was the big winner here. Now, I do want to spend a minute on the EPS revision cycle for traditional energy because it has been weighing on the stock. So this graph is energy's weight in the S&P 500. That's the gray line. And that bluer line is its earnings contribution to the S&P 500. You can see a very strong correlation. This goes back 30 plus years. And of course, most recently, you look at the far right here, from that peak in mid 2022 or late 2022, we've had a pretty meaningful or at least non-trivial earnings revision cycle downwards where S&P earnings have continued to go up and the energy sector's revisions have been negative. And it's led to, of course, a pullback here in energy's relative weighting in the S&P 500. You'd be hard pressed going back over these last 30 plus years to find a period where you could have negative earnings revisions and positive relative stock price performance. So this is not just crude pulling back. Natural gas prices have been weak in the US and Europe. LNG pricing's come off. Refining margins have come off. Oil, it's sort of hung in there a little bit better off its peak levels, but even that is showing signs of softness. And until we get back to a positive earnings revision cycle, it may be tough for the XLE to do better relative to the S&P 500. This is a key thing to watch. So I want to turn to looking at crude oil versus copper. And this is something that I used to spend a decent amount of time on, especially in that 2004 to 2014 super cycle era. The top graph is crude oil prices, which is the yellow line, versus spot copper prices, which is the orange line. And then the bottom graph is crude divided by copper, a kind of a relative valuation graph, if you will. And you can see the lines, the top lines. First of all, they generally do go together. There are periods where they diverge. And the way Bloomberg does this is it's this sort of reddish, brownish color when copper is outperforming crude, and it's a greenish color when crude is outperforming copper. Now look, this super cycle looks like it's a straight line up, but there was a lot of choppiness along the way. And we did spend a lot of time trying to understand what's going on with copper markets. And I had the good fortune at Goldman of having colleagues around the world, but in particular in China, and in other parts of Asia that really dove into some of the dynamics going on there. And again, while for crude oil, oil demand in China is only about 15% of oil markets. Important, but only 15%. In copper, I think you're now over 50% of global copper demand comes from China. So not only has copper always been sort of a very economically sensitive commodity, Dr. Copper, if you will, but it also was particular insight into China. So this bottom graph is the ratio of crude divided by copper. When the line is going up, crude is outperforming copper and vice versa. And first big observation is it's generally stable or within a band, if you will, over this 35-year period, which again coincides with that top graph where you can see the lines tend to move together. Therefore, the ratio should have a defined range to it. But there are a couple distinct periods that I want to highlight here. The first is the 2 periods where crude is trading weak relative to copper. So within this 35-year period, that ratio of crude divided by copper is in a little bit of a lower band. These are both periods where you generally thought to have easy to add incremental oil supply. It's the shale production now. I think the idea is if oil prices get too high, you can bring on shale production. And of course, in the 1990s, we were still working through the exploitation projects, as we would call them, from the 1970s boom. And again, the idea that you had sort of a lot of incremental non-OPEC supply to be brought on and perhaps some OPEC spare capacity. And I'd contrast that with the supercycle era. This is a period where incremental oil supply is not as easily brought on and you have to do a new exploration cycle, which led to shale eventually. But during this period, you had a crude trade relatively stronger, at least versus the other periods, versus copper. I think it is a confirming data point. We've used language that we are not in a super cycle for oil. We're in a super volatile commodity environment. And again, I think if you look at crude versus copper, it's another sort of confirming indicator that we're in one of those more volatile trading range for oil, but perhaps not a super cycle. So I want to hone in on this gap between copper and crude. So we're looking at, it's essentially just the top panel from that previous graph. I've got copper in red, crude in white. And you can see again this is now back to 2001, over the last 24 years, they've generally moved together. But I wanted to highlight 3 periods of divergence. The first is in the later stages of the supercycle era. And you can see copper was already showing signs of breaking down and indicating that perhaps the supercycle is over. Yet crude traded very strong relative to copper. Now, this was the early days for the shale revolution. Production was starting to ramp up. No one thought that it could sustain as it has, certainly not at the time. You also had a number of noticeable geopolitical disruptions. Libya went down. That was, I want to say, in 2014. You had some other country disruptions. And of course, OPEC was engaged to varying degrees in trying to cut production and manage the price as well. But you saw a divergence until that famous or infamous November 2014 Thanksgiving OPEC meeting where they said, no mas, we're flooding the market. We've had it with all this shale growth, and crude collapsed. And that period resolved with copper being right. Copper was indicating the super cycle was over, and the performance of crude was going to be unsustainable. Now, you have to be mindful. This lasted 2 years. You have to be very careful. And none of this is a trading call. This is meant to talk about what are the long-term implications, what can we learn from it? And it took 2 years for this to resolve, but it ultimately did resolve. The next period we want to highlight is the post-COVID recovery. And it's easy to look back now and say, oh yeah, crude went from -37 to as high as I think 120 or 130 at the peak of Russia-Ukraine. None of that was certain at the time, and certainly not pre-Russia-Ukraine. And if you remember when we had the initial bounce from COVID, oil started going a little bit sideways here. And there was thought that maybe we already had the full rebound in oil. I think I want to say oil was $40, $45 at the time. Yet copper was just going straight up and making new highs. This period of divergence clearly ended up reconverging, recoupling, with crude catching up to copper. Now you can say Russia-Ukraine played a role in this. It did, but some decent portions of recovery was prior to that. And regardless, it did resolve ultimately in crude catching up with copper. So you have now 2 periods of big gaps. And in both cases, crude went to where copper was. We're now in our 3rd period of a gap here, where copper, a commodity that is overwhelmingly exposed to China, seems to not be as worried about the China slowdown. You can say, well, some of the stimulus stuff, et cetera, that China announced last week is causing some of this bounce. Maybe it's a head fake, who knows? But there is a notable divergence. Now, we're not making trading calls here. These divergences can last for a period of time. I know some will say, well, copper is more exposed to electric vehicle ramp, power generation growth. You highlighted Vistra and the merchant power companies. They're more exposed to general growth in power generation and expanding our grid globally and so forth. And all of that is true for sure. And of course, crude has its own dynamics where there is legitimate concern about 2025 non-OPEC supply growth, concern as to whether OPEC will unwind production cuts at a time of what is generally thought to be less robust demand. But all of that is trading noise. Structurally, is there some reason to believe we've had a permanent breakdown? And we go back to Dr. Copper. If copper is an indication of global economic health, and again, we just highlighted a bunch of sub-issues. I'm not entirely dismissing them. I think we would expect ultimately for crude to recouple in the direction of copper as it has. Now, when is that going to occur? We do not have the answer to that, and it may not be for another year or two. These divergences can last for a period of time, but it is noteworthy. It is worth paying attention to, and I think it's something we're going to continue to spend some time on. And of course, if you look at the XLE, which I've now added to this graph, it is caught somewhere in between. Now, one disclosure I have to say here, this is not calibrated as a valuation graph. So don't look at this and say the XLE is discounting, XYZ oil price. That's not the purpose of this. I think it is reasonable to say we've had a sharper sell-off in crude oil than we have had in the XLE over this period. So there's some amount of, hey, is the crude price really correct going on as a question? I think if there is more downside in crude, if it was to have the rug pulled out from it, perhaps because OPEC unleashes its remaining oil, who knows what the reason is, I think you would have to wonder if that creates some downside risk. On the other hand, if we are actually in and going to be in a healthier global economic period, then at least what I think the crude oil prices are reflecting, then that's going to be the argument for the XLE. I'll go back to that EPS revision chart I think I showed as the second chart overall. You're going to need that EPS revision cycle to stop being negative, at least stabilize, and frankly, to start going up again. But right now, I think the title of this graph is correct. The XLE is kind of caught in between at the moment. So I'd like to end this video on a personal note. Congratulations to my wife for a hole-in-one at our club. It was during the mixed couples pots and pans, our final 18-hole mixed golf event, and it was on the 14th hole at our club. It's a downhill par 3. I want to say it's about 150 yards from the forward tees that the ladies hit from. Wife hit a great drive. She was the fourth person to hit. Me and my playing partner, Mark, we were both. I was in the left rough. He was in the right rough. This is a par 3, mind you. Mark's spouse, Kathy, was also, I think her tee shot was a little bit short. My wife hit a flush driver. It's going straight for the green. Again, this is a best ball of 4 of the couples net of handicap. And we're like, all right, thank goodness. It's at least going to be on the green. We have a chance to, walk away with maybe a birdie opportunity and hopefully at least a par. It bounced again. And again, a driver hitting that flag hit perfectly. And as you can see, went in the cup. And so it was a hole-in-one. This was, again, the final big tournament. With this hole-in-one, we were able to finish in the top 3 of pots and pans. Now, the field only consisted of 4 teams, but we played who we played in that 4th team. I think there was some controversy between one of the husband and wife pairings on the first hole, and they sort of self-disqualified. I think they're all okay, but they didn't finish the round. But whoever finished first, whoever finished second, none of them are going to remember this day. We are always going to remember this day. Congratulations to my wife for having a hole-in-one. And of course, it's the second in the family. That first one is yours truly. And it was at Bethpage Black, also in a tournament. This was an MGA Caddy Pro-Am. I was with one of the best golfers in our club, another excellent golfer, and our club pro. And with mine, I did win a Lexus. Now, winning a Lexus means you win a 2-year lease. That's the Lexus lady, by the way, who was manning the booth here. I, as you know, love driving my Tesla, so we did actually cash in the value of the lease. But I'll say the best part about winning these hole-in-ones, or having these hole-in-ones, not the car, it's actually these nice hole-in-one sort of plaques or commemorative things. My wife has gotten one from our head club pro for her hole-in-one. This is mine. And I just want to point out one aspect of my hole-in-one. You can see we identified my ball because of the Super Spike logo. Someone said there's an S on the ball. Whose ball is that? That's not an S. It's the Super Spike lightning bolt, which one of the playing partners is a reader, knew it immediately. And again, this was a congratulations to my wife, but of course, as a husband, I do have to highlight my own success here. I will say to my kids, mom's got one, dad's got one, especially our two younger kids. They're better golfers than either of us. Both of you need to get one. And our older daughter, who is also an excellent golfer, just doesn't practice much. Sweetheart, you've got a chance as well. With that, thank you all, and we'll see you next week.